I'm Scott Judds, Chief Science Officer of AlphaGen Strategies. With true sector rotation, we can break through the efficient frontier to achieve both higher returns and lower risk. I'll start with a short introduction, and then I'll show you that trends are real, meaning that markets are not efficient. I'll show you that risk and return are not mutually exclusive. I'll show you there is an optimum trend extraction method. I'll show you that we use forward walk progressive tuning. And finally, Brian will give you a live demonstration of the website. It all started when I discovered I had a problem. After what was called the go-go 80 stock market, I noticed it went up over 100%, but my IRA funds were flat. I read no shortage of newsletters, and each had great reasons why they were right, but there was certainly no consensus. I watched CNBC talking heads, and they managed to have 8 simultaneous different opinions. It then occurred to me that my coffee cup was probably right. If the nation's economists were laid end to end, they would point in all directions. And it turns out this is a fundamental truth. If there were not equal numbers pointing in opposite directions, the market would quickly adjust to make it true. Because experts do point in all directions, they are inherently only a 50-50 crapshoot for market prediction, and I didn't think 50-50 was going to help me much, so I concluded these guys are all just a soap opera. But I still like to watch them anyway. I did listen carefully to my financial advisor, who hypnotically said, diversify and rebalance, diversify and rebalance. To me, that sounds like own a little bit of everything, and I can achieve precisely average performance. Average? Was that my goal? Would that make my mother proud? But I noticed that these same industry giants don't achieve average with their own money. $100 million days? What's that about? How do you get some of that? With no apparent value in newsletters and talking heads, I wondered, what about the data? Does recent market data hold clues for future prices? In other words, do trend prices exist? I knew if I could get some data and do some experiments, I could answer this question. In 1992, I bumped into one of Fast Track's ads in the Wall Street Journal and subscribed, and I exported 3 years of data for 11 Fidelity mutual funds into this Quattro spreadsheet. And then I set up a few coefficients to calculate monthly trend correlations and used them to select the best fund to own for the next month, and concluded, indeed, trends do exist. For 1989, 90, and 91, it was showing a return of about 40% per year. I was pretty pumped. In 1992, I began playing with some software and developed it written in Visual Basic for DOS 1.0. Now that's truly prehistoric stuff. But what's life without a hobby? I called it Profit Taker then. In 2004, I started a redesign for a Windows environment, and many features were added, including in 2009, the StormGuard features for AlphaGen was developed to separately deal with moving to cash during major market downturns. In 2015, AlphaGen went live as a web-delivered service. This chart is typical of what you see online today. In short, in an AlphaGen strategy, you select symbols to participate. The trend algorithm picks which one to own now, and trade alerts are generated typically 3 to 5 times per year. The site is designed with a rich set of tools to empower independent financial advisors with true sector rotation technology and a framework that better helps them manage high-performance retirement portfolios for their clients. I said that I'd show you that trends are real, which means markets are not efficient. But let's review. The efficient market hypothesis says, paraphrasing, prices are already all past publicly available information, and one cannot returns in excess of average, and stock and other asset prices follow a random walk model. If true, diversification is best. But if trends are real, then the efficient market hypothesis is false. And notably, we're all here because we want to achieve returns in excess of average. So let's examine more proof that trends are real. In 1994, I ran into a fundamentally important book called Chaos and Order in Capital Markets by Edgar Peters. He discusses the rescaled range analysis developed by Edwin Hurst in 1907 for the Nile River Dam project for water flow analysis. Hurst thought he should know the character of the Nile River flow before designing the dam. Fortunately, he was in Egypt. There they had 2,000 years of data. Hirsch showed in this plot of rescaled range analysis that river flow statistics were much different from that of a random walk represented by this blue line, and that this difference was representative of its trend characteristics. Apparently the way storms flow over the tributary collection basin makes river flow statistics non-random. Edgar Peters decided to apply this analysis to the capital markets. For the math geeks among you, the rescaled range is calculated as the average over the range of the entire timescale, left to right, of the maximum range R in the interval n divided by the standard deviation of the data over each time interval n. When plotted for the S&P 500 on a log-log scale, it looks like the black line. If the data was a totally random walk, it would be like the blue line, and if the data was a linear trend, it would be like the green line. So what we see is that for longer time intervals, it is much more like a random walk. But for shorter time intervals, it clearly shows it contains trending characteristics in much the same way as the Nile River data. The slope of the line is called the Hurst exponent. Well, okay, that was a lot of geek speak, but here's what to remember. The same trending properties are seen for individual stocks, Japanese stocks, US Treasuries, and even economic indicators. Here the S&P 500 is shown decade by decade, one plot overlying the next. This stability and character over time is called statistical stationarity. Its characteristics remained stable in spite of depression, world war, politics, and technology. Market data reactions are really only about human reactions to new information. How long to believe, to buy in, to be afraid, and to take action. As a population, this character is baked in our genes, and thus stationarity should be expected. Other evidence that trends exist can be found in this nice article in The Economist from January 2011 entitled Momentum in Financial Markets, Why Newton Was Wrong. The article contains these two charts. The left one is a Credit Suisse study regarding British shares chosen for performance in the past 12 months and showing that the top 20% well outperformed the other groups. The right one is an AQR capital management study for US shares conducted in a similar manner, showing a similar outperformance of the top 20% ranked stocks. Further evidence that trends exist can be found in this industry white paper from Columbine Capital. It cites prior work by a number of researchers and of course how Columbine further improves the algorithms with their own secret sauce. Columbine publishes performance charts for a handful of models and sells data to capital management companies. This is their combination model starting in 1986. I've annotated the chart to show two lines of constant return to put them into perspective. The green line is the top 10% of sorted stocks, and the red line is the bottom 10% of sorted stocks. Finally, this peer-reviewed academic paper by Jagadish and Tietman from 2001 likewise demonstrates that trends exist in market data. In their paper, they divided the stock market into 10 portfolios grouped according to their prior 6-month return, then held those stocks for 6 months and repeated the process. They found that the portfolio P1, the upper 10% of the momentum sort, produced an average return of 1.65% per month, while the portfolio P10, the lower 10% of the sort, had only a 0.4% return per month. That's a very significant 16.8% per year difference. So, trends are real, and this is what they look like. Here, fund prices are plotted on the top, and their corresponding price trends are plotted below. They are plotted against time, and thus they are time domain data. Remember that term, time domain data. When prices of the orange fund is rising the fastest, the value of its trend is the highest. Thus, the best trend is our friend, and therefore, time domain data is also our friend. Yes, trends are real, and trends are, by definition, a portal to the future, where something in the recent past tells us that there's something about the near future we can count on. Thus, trends are, in fact, that crystal ball we all hope to find. And in fact, we're not limited to average performance. I said I'd show you that risk and return are not mutually exclusive. But let's review. Modern portfolio theory says one must trade risk for return. Let's check it out. Modern portfolio theory says If you have a risk-free money market fund here in green and other available investments over here in blue, then the best you can do is to construct portfolios along this efficient frontier line in red. In fact, modern portfolio theory says you can't make long-term portfolios in the upper left of this diagram. According to modern portfolio theory tenets, market prices are Gaussian distributed, rational investors trade risk for return, risk is measured as standard deviation of returns, and the efficient frontier is the set of best portfolios. But AlphaGen thinks otherwise. On this risk-return chart, an operating strategy is the additional use of trend-following algorithms that enables AlphaGen to live comfortably in the forbidden corner. Let's review those MPT tenets. That market prices are Gaussian distributed fails to consider the long tails that are way too fat in the real world. This is why 30-to-1 leveraging by banks was not safe. That rational investors trade risk for return fails to consider that new tools change the game. In a sword fight, Indiana Jones reduced his risk by bringing a gun. That risk is measured as standard deviation of return fails to consider that big returns aren't a bad thing, and this misrepresents risk in the decision process. That risk is reduced by owning uncorrelated assets fails to consider temporal avoidance as a method of risk reduction. And finally, that the efficient frontier is a set of best portfolios fails to consider that the efficient frontier might be an artifact of unfortunate self-imposed constraints caused by discarding time-domain trend information. Our poor MPT guy on the left says, "Can you help a disabled investor? I lost my time domain leg and I don't know what to do next." You see, statistics is the only leg he has to stand on. MPT mathematics are completely statistically based. Gaussian distributed, standard deviation, uncorrelated assets. Without time domain information, you have no trend information. Without trend information, modern portfolio theory is limited to buy and hold. And this is why MPT can't pick anything to own or avoid next month. Let's solve the problem. We want to know how to use the blue investment options to create a red portfolio to simultaneously reduce risk and improve returns. Modern portfolio theory says we can't get there with diversify and rebalance. But let's give it a try and see. I'm going to use the desktop version of AlphaGen for this demonstration. The vertical axis is logarithmic such that a fixed percentage return per year makes a straight line, as shown by the gray 10% return line. I've created 5 simple synthetic funds, each with a slightly different average return and each with a slightly different sinusoidal undulation to simulate uncorrelated assets. Their average returns vary from 5% to 9%, and the sinusoidal undulation period varies from 135 to 229 days. The upward slope of each undulation is 30% per year plus the base level of average return, so 39% per year for the orange fund. The risk-reward chart stacks the dots for these funds appropriately like this. Risk here is measured as the coefficient of variation. If we take these uncorrelated assets and diversify and rebalance as shown by the control in the lower left, using an equal 20% allocation for each and rebalancing quarterly, where these are the rebalancing indicators and rebalanced dates, then it produces the results shown by the yellow line above. With this concoction of uncorrelated signals, there are periods of time when they work together and other periods where they work against one another. On the risk-reward chart, the results show we have achieved the average of the returns, and as expected for uncorrelated assets, the risk is reduced by the square root of the number of participating funds. Conclusion: diversify and rebalance improves risk, but not returns. Well, diversification didn't cut it, so let's try trends and own only the trend leader. First, let's look at trend following mechanics with a very simple example. In the upper black chart, we have a simple sinusoidal fund in green and a pretty flat money market fund charted in purple, and the strategy results in yellow. In the lower chart, we see the short-term trend indicator for the green and purple funds indicating whether a fund is making money or losing money. A trend following algorithm says we should own the fund that has the most positive trend and thus most likely to do well next month. Thus, the yellow line goes up when the green fund has a positive return and should be owned, and bails to cash and goes flat when the money market is doing better. On the risk return chart, note that we have moved up and left at the same time. Now let's do trend following with all of those sinusoidal funds that we saw before. But first, let's zoom into a 2-year interval where we see the sinusoidal synthetic funds above and their corresponding trend indicators below, and where each yellow hash mark indicates a trade to a new fund when it becomes the trend leader, and producing this result by owning only the trend leader. If you think of these funds as market sectors, we are truly rotating from one sector to the next, and hence the name true sector rotation. True sector rotation is also called serial diversification, owning many funds, but only one at a time. As this chart shows, one can simultaneously achieve higher returns and lower risk by owning only the trend leader. And yes, this is the Holy Grail. But something is missing. Real markets have noise, and market noise makes our crystal ball foggy. Thus, the game is to extract signals from noisy market data, and this is the hard part of the job. I said that I'd show you that there is an optimum trend extraction method. Fortunately, I went to engineering school at Stanford where I studied signal processing theory, had a long electronics design career, and have numerous issued patents, even an authored optical sensors book. My career has been all about digging signals out of noise, and that is the problem we have before us. It's all about reducing the noise to better reveal the signal. Seeing even a little bit of the road ahead is a good thing. There are two primary tools that a good signal processing engineer would use. First is match filter processing to optimally shape a noise filter, and second, differential signal processing to eliminate common mode noise. Warning, there's a bit of geek speak ahead, and consider it entertaining background material that you don't have to remember. We'll start with match filter processing and its definition. A matched filter is the optimum linear filter for maximizing the signal-to-noise ratio in the presence of additive stochastic noise. Now there's a mouthful, and this means that the best filter shape matches the signal shape. That's pretty simple. Consider this radio spectrum signal in the frequency domain, where a matched filter would be shaped to match the spectrum of the signal, like this, to cut out the sideband noise. Now consider this time domain signal leading to an event. If we have many such examples, we might find a correlation signal before the event, like what happens before an earthquake. In this time domain example, a matched filter has an impulse response that is the mirror image shape of the correlation signal. Whew. So, what does that mean, and what is the event? Let's say the problem is wanting to know, should we move to the safety of cash? And we want to estimate market performance then for the whole next month. The method we'll use the S&P 500 index to represent overall market health. Negative returns are, of course, indicative of poor market health. So then, the event is next month's return, and thus we must find the correlation between next month's returns and the returns from the series of days prior to next month. This is that correlation. The horizontal axis is the number of days preceding the event, and the vertical axis is the correlation of the data to the event, with recent past days on the far right and far past days on the left. It has near zero correlation for days immediately preceding the event and grows to a peak a few months back in time. So again, we're looking for a filter with an impulse response that looks like the mirror image of the correlation between the event and the pre-event data. And this is that correlation event, which is next month's revert and the pre-event market data. Well, let's look at three candidate filters, two well-known and one not so well-known. In green is a 50-day moving average filter, and its impulse response is flat for 50 days and then goes to zero. In red is a 50-day exponential moving average filter, quite popular in market data analysis, declining exponentially to its 1/e point at 50 days. And in blue is a 50-day second-order exponential moving average filter with a humped impulse response. It clearly looks the most like the mirror image of the correlation data. So let's check it out. When you run the correlation data through these filters with different time constants, we see that it is true. The second-order exponential moving average filter in blue performs much better. StormGuard uses the 50-day second-order exponential moving average to decide when it's time to move to cache. These plots show the returns of numerous AlphaGen strategies versus different time constants for the filter. Their performance peak at about 50 days is not an accident. The market pullback in the summer of 2010 was StormGuard's first real-time test since its creation. The StormGuard indicator chart on the right shows that StormGuard came close to triggering a move to cache, but did not. The bottom chart shows that in the larger perspective, when compared to serious market downturns, StormGuard made the appropriate decision. However, 1 year later, in 2011, the U.S. debt downgrade and a threat of collapse of Greek debt scared the market a bit more, and for just a short time, StormGuard did trigger a move to cache. Although the natural instincts of many people is to want to pull the trigger and go to cache much quicker, it's important to remember that there's an optimum balance. If you react too fast, you suffer from whipsaw losses when sharp drops often snap back. And if you react too slowly, you will get hurt if it really is a major market collapse. Excuse me. So let's specifically look at how StormGuard affects strategy performance. This is a Fidelity sector fund strategy. The green line includes StormGuard, and the yellow line does not. The benefit of StormGuard comes exclusively during the two major market down periods in this 23-year chart. The cumulative strategy improvement achieved by including StormGuard is 86%. This second example is a Fidelity country fund strategy. Again, the green line includes StormGuard and the yellow line does not. And again, the benefit of StormGuard comes exclusively during the two major market down periods in this 23-year chart. The cumulative strategy improvement achieved by including StormGuard here is 65%. So in summary, one can use matched filter theory to first identify the signal leading to the event, identify a filter having a mirror image impulse response, which optimizes the algorithm response and actually produces results worthy of our attention. Now let's address differential signal processing to eliminate common mode noise. This chart has a dozen broadly diversified funds, each of them with a slightly different focus. It's pretty clear that there's a lot of common mode market noise within each of them. If we take two mutual funds, a finance sector fund and a healthcare sector fund, and do the usual correlation calculation over time, we see this blue line telling us that they have a lot in common. However, when a 60-day moving average filter is applied to the data to remove short-term common mode noise, we see something entirely different. These negative correlation spikes are periods when longer-term fund trends are opposite one another. One fund is increasing while the other is decreasing. And there's no good reason to own both funds. Diversification does not justify owning a poorly performing fund. Detecting trends is what it's all about. Before examining differential signal processing, let's first examine solo signal processing, which means making a decision by looking only at a single fund. In this case, Fidelity Medical Delivery, FSHCX, is plotted in green above, and the red line is a money market fund. Here, our investment rule will be that we will own FSHCX whenever the trend for its daily return is higher than that for the money market return, and own the money market fund otherwise. There are 10 little lines on the bottom chart, each indicating a trade from one to another. Each of these trades are shown on the top chart by the yellow line, and clearly performance is shown fairly poorly, primarily because it too often is the victim of whipsaw losses. We need a second sector fund to do differential signal processing, and let's use Fidelity Electronics, FSELX, shown in red. And first, let's look again at the signal processing for the solo treatment. And we see here, it too suffers whipsaw losses and has at least 10 trades, including this burst of indecision trades. However, when FSELX and FSHCX are played against one another to eliminate their common mode noise from the decision process, the results are completely different. Now there are only 3 trades. Now whipsaw losses have disappeared, and the trade decision results are comparatively spectacular. The electronics engineer would diagram it this way. First, you apply matched filter designed to optimally extract the trend signals. Then you apply a differential comparator to eliminate common mode noise, and the result is a decision of what to own right now. Interestingly, high-performance Ethernet and USB signal processing is done in exactly this way, and for very good reason. In summary, it's not a solo contest. It's a horse race. Change horses to stay on the fastest horse. It's fine to change horses in the middle of the strain, but don't get whipsawed. I said that I'd show you that we use forward walk progressive tuning, because the question really is, can this series of trades actually be found walking forward in time without the vision of hindsight? Forward walk testing is a very rigorous test of investment algorithms and is considered the gold standard for believable backtesting. Progressive tuning allows the algorithm to adapt to changes in the character of data over time. As illustrated here, at some point in time labeled now, the algorithm looks back over past data and determines how best to tune the strategy. Then it uses these parameters for the next 125 days and pauses to repeat the procedure, and so on across a span of time. Forward walk progressive tuning produced the nice results shown on this chart. And in fact, here's a comparison of the strategy using forward walk progressive tuning on the right and the same strategy tuned by hand in hindsight on the left, showing remarkably similar performance and illustrating that your AlphaGen strategies will have believable performance characteristics. So, with true sector rotation, you can break through the efficient frontier. And now, Brian will give you a live demonstration of how all of this works. As soon as I pass the screen back to Brian, or he will take it.
I will take it. Thanks, Scott. All right. Hopefully everyone can see my screen now. So one of the things that you'll note from Scott is he's extremely well versed in the construction portion of it. Scott and I have been working together for a while now on how do we make a usable tool for financial advisors. And I guess I'd start by talking a little bit about the fact that I do have my own financial advisory practice. We manage money for individual investors. And we've gone through lots of different variations over the last 20 years in terms of the way that we manage money, anywhere from individual securities to managed accounts to outsourcing third-party money managers. And what we recognized was that the bulk of the strategies out there, and even the larger firms that many of us have worked for, sort of default to the modern portfolio theory concept. There are tactical asset managers out there that use quant-based systems, and some of them have decent returns. But what's unique about AlphaGen strategies is the ability to actually build your own portfolios and then let the system do the research and the security selection for you. And so I'm going to walk through today an example of essentially how do I get started with the system, how would I build a strategy, how would I build a portfolio, and then how would I implement that across my practice. And we can talk a little bit about what the benefits of that are. So the first thing is that inside of our system we have a strategies management page, and one of the things Scott had talked about was that the holy grail being this idea of serial diversification, where we're just going to own lots of different assets, lots of different investments, but we're just going to own one at a time. And so this is really the genesis of that. This is the idea where we're going to take and build a strategy that includes many different assets, and then we're going to allow the system to tell us which one of those should we own using the science behind what Scott just talked about. So if I'm in here on the strategies management page, the way to get started would be we'd create a new strategy. We'd call it something, and I'm going to leave everything kind of set. I'm going to call it an ETF strategy to start, and we're going to save it here, and I'll be able to drill down into that strategy, and here it is. So now I've put it on the system. I have to decide what are the investments that I'm going to pull into that strategy, and there's essentially anything can be put in here, but let's say we're going to use mutual funds. When you type in the symbols in here, the system and type of symbol that actually works. We'll go out and find that particular symbol. You can select on it, use that, and it'll put it into the strategy for you. And you can pick up to 12 symbols to put into the strategy. You can pick ETFs and mutual funds, and our feeds have just about everyone that's out there. And if we don't have it, it's pretty easy for us to add that. So I'll just add a few different things just to show you how it works, and we can pull that in. What's interesting about this is that that the system will, as we're doing this, will dynamically analyze it and build the strategy for you. So I've got some pre-built strategies here. You can see what's interesting about these is that they're already built here. You've got a couple of buttons. We can talk a little bit about it. There's a spot in here. I don't like that symbol. There's a spot in here where I can show you some of the. I can actually pick pre-built strategies and populate them into the system. I can rank them. So if I go here back to this first section that I was looking at, if I wanted to pull in a strategy, I could pick one that I like, and there's several of them in here. Here's a Fidelity Diversified Strategy. I can pull that in, and the system will think for a second, and it adds that strategy to the system. I can pull up on a chart, and it'll show you exactly all of the backdated history, the back-tested history on this particular strategy. And you can see right off the bat, the yellow line represents the strategy. The other lines represent the positions within that strategy, and you can see this very effective strategy. These yellow dots here are indicating the forward walk progressive testing, so we can tell very quickly that, hey, this system works great in real time. A couple of things you can point out, I'll point out to you on the chart, is the historical performance. So we give you a 3-year, 10-year, and 27-year history on the performance with these particular funds. You can see here where the risk return chart reflects that we've achieved that upper left-hand quadrant that Scott talked about. And a couple of other things that we measure on here: Sharpe ratio, Sortino ratio, max drawdown, and gives you just a little bit of data at your fingertips, so you can kind of see relatively quickly, is this strategy working? So that's essentially the strategy. I don't know, Scott, do you want to add anything to that? I think you may be muted. That's okay. So we'll move to the portfolio section, and if I take off the filters, one of the things I'll point out to you is that our strategies, you can have several hundred strategies that you build in here, and that's one of the unique pieces of the software is that it allows you to build literally almost unlimited numbers of strategies, and then take those strategies and build portfolios. So from a practical perspective, Scott had talked about the longer term, wanting to own only the best fund, having lots of different funds, but owning only one at a time. Again, from a practical strategy, as a financial advisor, that's a challenging environment to manage your client's money. And imagine a client comes in and says, hey, Brian, I'd like you to manage my retirement portfolio. Here it is. I've got $1 million. And I say, great, we're going to put it into one fund. but it'll be lots of different funds, but we're only going to own one at a time. I think many of us would have a challenge actually making that work from a practical sense. So one of the things that makes this system great is the ability to build portfolios out of effective strategies. And if we go over here to the portfolio section, you'll see that this is where portfolios can be constructed. And so we've got some pre-constructed portfolios in here. And here's the Fidelity portfolio that's made up of these 5 strategies. So this portfolio would be represented by 5 different positions at any given time. And if I hover over each position, you'll see that the funds that are available in that strategy and the fund selection is highlighted in green. Again, the same over strategy, position number 2, position number 3, position number 4, and position number 5. If we look at this portfolio, one of the other things that's we're able to do in here is we're able to set the weighting. So this assumes equal weighted 20% in each one, but I can overweight or underweight in positions if I want to, and that'll change the dynamics in the within how this works. So I can change weightings, I can change strategies, I can add strategies to this. So if I said, hey, I want to add another strategy, this ETF strategy, I want to add that to it, I can certainly do that. And what you'll notice over here is if there's trades that are pending, now I just added a new strategy. I don't own that strategy. I don't own the position in that strategy inside of the fund. So the system is smart enough to tell me, hey, you have a trade. So I can click on this pending trade. It'll tell me I didn't own anything before, and now I would like you to own this MUB, which is a muni bond ETF. So I can acknowledge that trade. I can go back in here and delete that delete that symbol so that I'm back to my regular strategy, and then I can actually look at the performance of the portfolio, which is really a compilation of all 5 of those strategies through the chart system again. And if we look here, certainly what you'll notice here is, again, a couple of things to point out. The white line here is the S&P 500. These other colored lines represent each of the strategies, and in this case we have equal weighting, so we would expect to see some averaging between all of those, but that's what the yellow line represents, is the performance of this. Again, you can see the performance represented down here in 3 years, 10 years, 27-year time frames, and then the portfolio here again being up and to the left on the from the S&P 500 in terms of risk and return. Drawdown for the overall portfolio, in this case 28%, and Sharpe ratio 1.78, and a Sortino ratio, for those of you who are familiar with it, of 12.8, which is pretty outstanding. So again, the system is designed to allow you to create really as many portfolios as anybody would practically use. I think we can create up to 200 portfolios. But the idea is that if you're running models, the system does the work for you. It basically tells you once the models are built, once these model portfolios are built, the only thing that you're really going to be required to do is to come in and check your trades, and the system will alert you to them, so you don't even need to actually look in on it every day. The system will send you an alert via email or even text message to your phone and let you know, hey, there's been a trade signal indicated in one of your portfolios. You go to the system and look at that. So I'm going to add a strategy here just to show you how that works. There's a couple of different ways that you can affect your trade signals. So one would be coming to the portfolio section and clicking on the trade signals. Again, this would tell me, hey, in this particular portfolio on position number 6, you need to buy the muni bond fund, or ETF here. You can acknowledge the trade right there. The other place that will happen if you get your email and you just click on the link, it'll take you to the trades management page. And the trades management page is helpful in, it will actually, if there's trades in multiple portfolios, they'll have them all listed here. It'll give you some information about the history of that particular strategy. This is a new one I just put in there, so there is no history. There is the date of the trade signal, so we track all of that information for performance reporting, and we didn't have anything that we're selling. Again, this was a new strategy that we just added to this portfolio. The buy signal is this muni bond ETF, and I can acknowledge the trade right from here. And what's great about this side of acknowledging the trade is, let's say I've decided I get a signal on a fund, and it might be an A share mutual fund that we've put in the system, and we've got the A share in there because it's got a longer track record, a little better results from the analysis on the system, but we want to substitute that for the institutional share, and I'm just going to put something in here, but if we can put a fund in there that we want to replace it by, it puts a substitute in there if we want to do that, and we can and then acknowledge that trade. The system will then track that trade from that position going forward. So that's very flexible system, very flexible with regards to hey, once you tell it to do something, it tells you to trade something. If you want to override that, you can do that. So that's sort of an overview of the whole system. I think there are some practical applications of this, which is really how do you put it into practice in your own business. A couple of things we recognized as we were building our business was that that third-party money managers do a great job. They take care of the investments out there, but that, as I mentioned before, that many of them are very much focused on the modern portfolio theory, and even if you find tactical managers, in a lot of cases, they're not a full-blown solution, and so you're trying to piece things together. In addition to that, our experience has been that third-party asset managers have fees in the neighborhood of 40, 50, 80, 100 basis points in some cases for the more tactical managers. And so there's a relatively significant cost savings on that from our by utilizing our system. In addition, you can customize portfolios. So if you have clients that want something, they don't want exposure to one thing or another, or do you want to really customize a portfolio for some of your higher net worth clients, the system is set up so that you can actually build portfolios for specific clients and trade those specific to their needs. So there's a lot more personalization that's able to happen in here. And what we've found is with a system like this, with all of the science behind it and the goal of achieving greater than average returns, that we're able to actually go back to our clients and use that as a catalyst for having a conversation about higher fees. And we were able to convert. A couple of years ago, we've been able to convert an entire practice and almost double our pricing on from what we were charging before to a higher price point, and had 100% acceptance on that because of what we were able to show them with this. So I think from that perspective, we were able to really find a ton of value in this system, and highly believe in it, and think that everybody ought to be. If they're interested in running the portfolios themselves and want higher customization and are looking for a way to say, hey, in an environment where fees are being squeezed, we have something that's different than any of the advisors here in town, and being able to show them this. So that's kind of a basic overview. What I'd like to do is invite anybody who'd like to maybe talk about this one-on-one, more personally about, what's your practice look like and how could I integrate it into my own practice. I think we'd be happy to have those conversations with you. I will send out a follow-up email following the meeting today, and ask if you're interested to certainly reach out to us. You might also go to the website alphagenstrategies.com and feel free to look around in here. You won't be able to log in and see this information here, but if you schedule a meeting with me, I'll be happy to set up a trial account for you for 90 days. It's fully functional, fully usable. You can actually build out portfolios, see how they work, and get your feet wet and a full understanding. And we'll give you as much time and attention as you need to make sure you understand it. So that's about all I've got on this. Does anybody on the call have any questions? Anything I can answer for you? All right. Well, hearing none, I think we'll conclude for today. Again, I thank you all for taking the time to come watch and learn a little bit more about AlphaGen strategies. I think we'd again like to invite you to talk to us one-on-one. I think we've got a pretty neat, unique system here that will allow you to have some great customization and give you a catalyst for increasing your fees over time. So again, my name is Brian Sullivan. My partner, Scott Judds. We thank you for your time, and we look forward to talking to you more in the future. Scott, are you there?
I'm here. Looks like we had one guy, huh?
Yeah, looks like